Hi, welcome back to Srihari Degree and PG College Education YouTube channel. In this session, I am going to introduce you the first topic in the Unit 1 of your financial market subject. That is Basics of Investment. Actually, this particular chapter is about Introduction to Financial Markets. In this chapter, you are going to get some fundamental aspects about these financial markets. In this topic, you are going to have a clear understanding about the concept called investment. No doubt, I think we all are well about the term investment. Usually, investment is referred to the saving the money in the purchase of so and so assets. But it's a general meaning. Usually, common people may think that, for example, if they buy any commodity or if they buy any asset, they may be used as in terms of the investment. But in our financial sense, according to our syllabus or our subject, you need to understand the term in a clear way. Here, investment refers to the use of money. Remember, here usually investment begins with the savings. Every investor or the proposed investor who wants to invest his money, usually he should be ready with the money. Whenever he is ready with the money, immediately he thinks of various options that are available in front of him in order to deposit or invest his money. Where he invests his money? He invests his money in form of purchasing various financial assets. What are those financial assets means? Like equity shares, preference shares, debentures, and so on. See, why an investor invests his money or his savings in purchase of financial assets? Because with a hope. What is that hope? That is to make more money. Whenever an investor invests a rupee means after a certain period of time he expects more than a rupee. It may be 2 rupees or 3 rupees. So, fundamentally speaking, investment is a broad concept, multifaceted concept. And moreover, what happens exactly in the investment process? In the investment process, the investor has to purchase certain financial assets or the financial, like what we call the products, like equity shares, preference shares, debentures, bonds, and so on. See, of buying means what? It indicates that the investor is ready to take the risk. Here, investment is all about risk taking. Because you know well, we may expect greater returns, but it all depends upon how extent we are able to manage the risk. The risk and returns are just like twins. You can't see one in the absence of other, because they both exist in each and every investment option. And here, see, we are speaking about the money. Here we are investing the money. From where? From the savings. No investor will invest his total money in form of the investments, because he segregates. He divides the total money into various proportions. For certain proportion only he is going to invest the money in form of purchasing these financial products. And again, here look at this definition. This simple definition gives you a clear understanding about this investment. An investment is a commitment of funds. See, here we are talking about the commitment. See, it is not like that investing today, say 1 lakh or 2 lakhs, and immediately expecting the returns. By tomorrow or day after tomorrow, it doesn't happen. It takes a long period of time. It takes some period. So for that, the investor needs certain kind of commitment. Commitment towards taking the risk. Then, and make in the expectation of some positive rate of return. See here, commitment is required for what? To have some kind of expectation. See, what is that expectation does the investor have here? That is a positive rate of return. Expecting a positive rate of return. Always, this is the factor which motivates the investor to go with the investment option, a rate of return. It means the benefits the earnings, whatever the investor is going to receive after a period of time. So this simple definition, it depicts all the things about the investment concept. And here you need to understand there are two concepts which plays a very vital role in the investment. The first is economic investment and second is financial investment. What is this economic investment? Here economic investment refers to this particular term deals with the addition to the existing capital stock. It means your investment is used to produce the goods and services in the industry. So in the sense, indirectly, the investor is encouraging the country's production. You may be called like this. It may result in the increase of the assets, like buildings, land, plant and machinery, etc., etc. The result in this economic investment particularly result in the increase of the assets, specific assets, which are directly in connection with the production of goods and services. The second concept, the financial investment. This particular concept, it clearly deals with our financial market subject. See, according to this concept, investment refers to it happens or it occurs because of the exchange of financial claims. Here there are two parties, one seller, another buyer. These two parties will gather at one particular place and starts exchanging the various financial claims, like buying of shares or selling of shares, like this. All this happens in this financial investment concept. This concept covers this particular aspect. So the first economic investment, it deals with the increasing the production related activities in the nation, and second concept, it deals with the exact process what happens in financial markets between the parties, various parties. And next concept is, next topic is objectives or attributes of this investment. Yes, this investment has majorly three attributes or three properties. The first property is safety and security. Investor always looks for this particular character, the existence of this particular character, that is safety and security. See, because money is so precious, we all know that. So whatever the money we are spending in form of investment means our expectations are much more. In future, that particular investment has to generate more returns. So here, safety and security refers to the risk management. Here, we need safety for what? For the principal amount. For example, an investor invested 1 lakh rupee in the purchase of shares. Usually, before going into the analyzing of these returns, the investor usually thinks about his principal amount, whether my principal amount is safe. Then only he thinks about the dividends and so on, so other incomes. And security. Here, security is also important. Fundamentally, it plays very important role because risk is unavoidable. See, we cannot control this risk, but we can minimize this risk. The risk minimization is one of the biggest concept in these financial markets. We'll discuss in our later classes. Then, second attribute is profitability. Profits, yes. Investment and rate of return. They always just like friends. See, whenever an investor thinks about investment means, he always expects the rate of return. Usually, higher rate of return. So, our investment should ensure this property. That is, our investment in future should generate more returns or according to our expectations. We cannot say all the things in advance, but it's all depends upon the speculation that we are making here. Then liquidity. The last property is liquidity. Liquidity is a factor. It is related to the easy convertibility of assets into cash. See, sometimes investor may need money. For example, assume that there is one investor who invested his money in shares. It happened 3 months back ago, but now he needs money. He can't wait further. So in such a case, he should be able to convert his financial assets into cash whenever he requires. so that he can fulfill his needs. So that particular attribute, it strengthens the basic objective of this investment. So these are the three important attributes that plays a very vital role in the investment concept. Now, I'll go with the next concept in the basics of investment, that is the investment process. Because the term investment is a very big term. It can't be defined in a single context. See, it involves a process. It is a systematic approach. And moreover, it doesn't mean only spending money in buying of financial security. It is more than that. Let us examine what happens exactly in the investment process. As you know well, the investment process is initiated by the investor itself. See, there are, fundamentally speaking, 6 steps are there. Let me explain you one by one. The first step is investment policy. It is the first step, though it is the first step, but the investor should be very careful while at this point only. Because we have different types of financial securities. All those securities have different features or different attributes. Some securities are very highly risk in nature. Some they are preferably process less risk. So depends upon that, the investor should come forward with a clear mind about his investment decision or his investment policy. Later, he will do the analysis. That is investment analysis. Now, where the money is going to be kept. Now the investor is ready. His policy is very clear towards the risk and return. The next step is analysis. He should have the clear idea about each and every security in which he is going to invest. Whether it may be in capital market or it may be in money market or derivatives, whatever it may be. Whatever the financial security, he has to know all the things, the pros and cons of each and every security. This analysis is done along with the financial experts. Usually, the investors may not have or may have the knowledge in financial markets, but it is better to seek the expert's opinion. The third step is, after doing the analysis, next is valuating the securities. Now, the investor is ready with his investment option. He is ready to buy. For example, he intends to buy some equity shares of so-and-so company. So, he did analysis. Now, valuation is very important. We have different approaches to evaluate the securities, like valuation of equity shares, valuation of preference shares, valuation of debentures, or like that. So, by applying those financial formulas and equations, you can derive the concept of valuation of securities. Later, constructing the portfolio. Remember, portfolio. In simple terms, I'll tell you what is this portfolio. Portfolio means a group. In our language, collection of securities. Investor, that usually no investor will invest his total amount in one particular security. He'll divide his investment into different categories. He is going to divide his investment in various proportions, so that in order to divert the risk or in order to control the risk, he will do this particular activity. That is a portfolio. So the loss, whatever happened in one security, may be covered with the profit in another security. So in such a way that portfolio construction is required. This portfolio construction is also again prepared by the financial expert. If the investor has sufficient knowledge in the finance field, means he can. Otherwise, he can approach the financial expert to prepare this financial portfolio construction. Then investment. Now everything is over. Now the investor is with all the things, all the arms and ammunition. Now he is ready to invest his money in a portfolio. Right, while constructing the portfolio, usually the investor may arrive at different conclusions. He may come up with different plans like plan A, plan B, plan C. He is going to pick the best plan out of the available plans. After deciding that, he will go investing his money in that identified or the best plan. The last one is evaluation. That evaluation means looking back. Looking back. See, evaluation is very, very important in the investment process. Because after investing the money, the chapter is not over. Because even after investing the money also, the investor should be very careful about the things whatever happening in the market. And moreover, he should very carefully analyze whatever the things he has done earlier, whether they are right or wrong. At that point of time, they may be seen as right. But due to the situations changes or the market conditions, so you know well, market is very dynamic. So we should be very careful with all the things, whatever happening in and around us. So evaluation is very important. Sometimes your investment may give you a positive rate of returns. Sometimes may not give you a positive rate of return. So but you should be dare enough to accept the things. So in such a way, the investment process begins and ends.